All right, folks, welcome to Investing for Beginners podcast. Today we have episode 371. Today we're going to break down Warren Buffett's quality criteria. He has 4 filters that he's talked about throughout his shareholder letters, explaining how we can find good, great, or possibly gruesome businesses. And he talks about in one of his shareholder letters about what he thinks are good and great gruesome businesses. And Andrew and I thought we would kind of take that and run with it. So let's talk about his 4 filters first. What are your thoughts on the 4 filters and how should we kind of try to use them?
I think it all makes sense. There are downsides if you do not have these things, for sure.
Mm-hmm.
So each of these filters, the flip side of it is a way to lose a lot of money.
Mm-hmm.
So I think it makes some great filters.
Yeah, for sure. So for those unfamiliar with what we're talking about, Warren Buffett, he and Charlie Munger both explain kind of their 4 filters that they use to try to find potential investments. So number 1 was find a business they understand. Number 2, find a company that has favorable growth prospects. Number 3, find trustworthy management. And number 4, find the company at a sensible price. So he uses different words. I'm just kind of paraphrasing so you could fit in an infographic, but those are what he uses to help us find different companies. So I think those are a great way to start to kind of look for potential investments.
Yeah. So why is it important to understand the business? I mean, that sounds so simple, but
right, it does. Yeah. If you don't understand the business, then the other 3 parts you can't really understand. And if you don't know how they make money and you don't understand how they could lose money, just as importantly, then, figuring out a good price or finding out if it's going to grow or not, or really liking management, those are all kind of moot points if you don't understand what the business is. And I'm not saying that you need to understand all the finer technical details of maybe a pharmaceutical business, but you at least need to understand what the drugs are, what they're making, how they make them, and who they're selling to, and whether the people they're selling to is big enough TAM or big enough opportunity to make some money. And so if you don't understand those things, the rest of it just kind of all falls apart.
Agree with all of that 100%. And good to have that one number 1 at the top because, like you said, all of the rest flows down.
Mm-hmm.
The other thing I guess I would add is if you don't understand the business, then when the stock price crashes, you're probably going to freak out.
Yep.
And if you're trying to buy low and sell high, or at least buy sensibly and sell at a higher price way down in the future, that's going to be really hard to do if you're panicking when the market's panicking because newsflash, the market panics a lot.
Mm-hmm. It does indeed. It can be a very fickle instrument, and Mr. Market loves to throw chaos to the wind for sure. And yeah, I think that's a great point. If you don't understand the business, when things aren't going well, you're going to overreact because you don't understand the business well enough.
Are there businesses for you personally when you're starting your journey that were just too hard to understand, but then you were able to understand them later over time?
Yes, absolutely. Visa and MasterCard are probably the perfect case points for me. When I first got into the investment gig, everybody talked about what great businesses Visa and MasterCard were. Obviously, I knew what they were, but I didn't understand how they make money. I couldn't get it. And I would read their 10Ks, I would read other people's articles, and I just didn't really understand it. Maybe I'm just slow, but it just wasn't a thing that just made a lot of sense to me. And then during the pandemic, when I had extra time on my hands, I watched a few videos on YouTube and I read some articles about maybe how they made money. And then for whatever reason, it just clicked. I started to understand it. And I actually made some infographics as I was trying to learn about the business and write about it for our blog. By me doing those 2 things, it really helped crystallize and clarify exactly what it is they do. And then all of a sudden, once I got it, I was like, how could I not understand this? Because it seems so simple. That was definitely one for me. Have you had an experience like that?
Yeah, I mean, also Visa, MasterCard, but I had your stuff to leverage, so that was nice. Yeah, I still have businesses like that, and for me, when an industry is young or maybe new and emerging, it's very hard for me to understand those.
Mhm.
And so I guess the beauty in investing is if you stay continuously curious, you can stumble upon the information that teaches you what you need to know to make a good investment.
Mhm. Yeah, yeah, exactly. Yeah. If you don't understand the business, it's okay to put it on the too hard pile for now and move on to something that you do understand, because that is a better way to invest. It's not a good idea to just buy something just cuz. There's plenty of, fish in the sea, there's plenty of opportunities to invest, and you don't have to swing at every single pitch.
Do you think there's some businesses that are just kind of impossible to understand and people who are betting on them are really just kind of throwing dice?
I think there probably is to a certain extent. I have never played in this space, so I'm saying this from a fair amount of level of ignorance. But like the biopharma area, where they're basically, my understanding is you're basically gambling on a company coming up with a drug that they can sell to help solve a problem, but the likelihood of them hitting a home run with a particular drug is very low. And so just, I don't quite understand. It feels like voodoo to me because I'm not in the industry. And that just feels like you're guessing. And there's no hard and fast way to determine whether this one is going to be successful versus another one. And I also feel like oil commodities to a certain extent are voodoo to me, but that's just because I don't know it and I haven't studied it. So that to me definitely falls into the, like, no way.
Yeah, I mean, to the whole oil thing, there's a lot of geopolitics involved with that, right?
Mhm.
At least in today's day and age. So
Yeah.
that definitely makes it hard.
Yes. Yeah. It makes it very hard. Very hard. So I guess if we look at the other three parts of the filter, like, uh, we've talked about a sensible price and growth. Do you feel like management maybe is something that should have a little more emphasis than maybe it normally gets?
I don't know. I probably put less emphasis than some people out there, but you definitely don't want an untrustworthy management. I think to say I'm going to buy a business, unless the CEO plays an outsized role in how the business performs, kind of like a Buffett would, in that he's picking stocks for Berkshire.
Right.
There's a few businesses like that where the CEO, like the business kind of lives or dies on them. But I think there's a lot of businesses where you just don't need a ham sandwich as CEO,
Right.
like you said before. And I love those type of businesses because it reduces the rate of error.
Hmm.
It's like
Yeah.
easier to sleep at night, I guess.
Right. Yeah, for sure. I think when you're looking at the companies, it's good to have, businesses that are so strong that you don't need superstar managers to, drive the businesses. And I think as the companies mature, hopefully that can be less and less, that you need that superstar to drive it forward. And that's one of the things that's going to be interesting to see how a company like Amazon does now that Jeff Bezos has stepped away from operations. 10, 20 years from now, is it still going to be, arguably as great a business as it was when he was running it, or when Elon Musk steps away from Tesla someday, if he ever does, to see, how much impact does that really have on the business? And I guess the flip side of that is, Target is going through a rough stumble at the moment. And you wonder if they had different management in there, if some of those things would happen or not.
Yeah. Yeah. Hard to say.
Mm-hmm.
Are there like warning signs, yellow flags, red flags that would signal to you that this is a management that's not trustworthy?
I think there's a couple things. Number one, I guess the first thing is if you see them saying one thing and then doing another, that would be cause for potential concern. The other part of that would be if they're starting to award themselves a lot of stock-based compensation for maybe not great targets like stock market returns or something. I'm not a big fan of that one in particular because they don't necessarily have much control over that. But I think if you're looking at, I guess, those two things, that would be probably the two that I would probably pay the biggest attention to, is if they're saying one thing and then doing another, and then if they're paying themselves what seems maybe like a little bit more exorbitant than really is verified or validated. The Intel CEO recently was trying to get his own, I guess, $100 million or so pay approved, and shareholders rightfully denied him that. But so those kinds of things are like, really? You really think that's justified when the company is doing so poorly, not only performance-wise in the stock market, but just execution-wise or operationally wise, it seems to be doing quite poorly. And you think that really is worthy of a big pay raise like that? It's like, yeah. So those kinds of things to me set off alarm bells.
I'd say for me, acquisitions that I question, those for me make me think, okay, if you've pillaged the business once and, you know, in your ambition made a poor acquisition, I feel like as a shareholder, if you do it again, that's on me, right?
Right.
Fool me once, shame on you. Fool me twice. So that's one that I try to look for really hard. And then also just like leveraging up to buy back stock. Starbucks 5 years ago. So you could argue the company's still dealing with that a little bit, but
right.
Yeah, that manager's gone. So
yeah. I would hazard to guess that alongside him doing that, he was probably on his side, probably getting compensated for earnings per share growing. And that's one of the ways that a manager could, air quote, potentially manipulate that is by buying back a lot of shares. And I don't know that for a fact, I'm just speculating, but I wouldn't be shocked if he was getting compensated on, growing earnings per share. And now that's one way they could do that. So that definitely falls into the line of, not trustworthy.
100%.
Yeah, for sure. If we kind of take these ideas of these 4 filters, how do you think we could kind of apply them to like the good, great, and gruesome businesses, if you will? Like what would be a couple that maybe would stand out as potential great ones based on his filters?
A couple businesses that are great. It would definitely come down to like companies with good moats, right? Favorable growth prospects is one I try to look for. Builders First Source is a company like that where they are part of home building, which has a nice tailwind to it just naturally because people need to live in homes. And then they also have a very fragmented market, and they are the leader in that market, and they are growing really well and have a really valuable service that's differentiated from a lot of their competitors. So to me, like favorable growth prospects, understanding the business is required and understanding why it has favorable growth prospects. But to me, that would be one example of kind of being on that value chain somewhere and just having a really great niche and having room to grow.
Yeah, that's a great example. A company like MasterCard really kind of jumps out to me. I've talked about Visa ad nauseum, but MasterCard definitely would kind of fly under that umbrella for me because it has a great business and it has a great moat, and it does a great job of returning capital to shareholders and continues to grow. And it definitely does not, its success does not depend on a superstar manager. It doesn't need Elon Musk to drive it to success. It can kind of function on its own. And because it earns such great returns, there's always somebody coming for it. So competition is kind of I think can be a two-edged sword. Number one, it can be great because it can drive you to be better and try to improve and keep growing because you don't want somebody to pass you on the racetrack. So there's that. And then the other part of it though is that it can be, it could be a grind. And if you're not careful and you don't have people that are diligent and staying on top of their business, they can get lapped. They can get passed. And then once you get passed, I think it's really, really hard and probably nigh impossible to try to recover that. I'm in a snapshot, I'm failing to think of a situation where a company has been passed on their moat and they've been able to get it back. I'm sure there's examples. I just can't think of them. And so to me, that's why having management stay on top of the business and continue to invest and not sit on their laurels and try to continue to improve. To me, that's one of the things that makes a company like MasterCard such a great business, is because I think it answers all those questions.
Yeah. I'm struggling to think of one too. It's very hard for, like, if you hear of companies that make a comeback, a lot of times, that could be from like a company pivoting or something.
Right.
Like I'm thinking of Microsoft and how, the cloud really saved them. It's not often you hear that. For sure.
No, for sure not. So we're talking about great businesses. What are some maybe good businesses that are maybe not as awesome as somebody like a home builder or a MasterCard, but still is a decent potential investment?
I think health insurance stocks look interesting right now. The market hasn't thought so. They've been kind of left behind, if not some of them beaten up. But for the most part, they seem to be growing their profits quite well. I mean, I know there's some attrition from some of the Medicare stuff and some of the memberships coming down for some of these. But from a profitability standpoint, it looks pretty nice. I guess the question is maybe the perception there is that maybe the moat's not as strong as people thought 3-4 years ago. So maybe it's just a good and not a great business, but definitely not performing like either at the moment.
Right. Yeah. To me, I think it's a space that I am interested in, have never really been able to find ideas or find the right idea, and that's the utility space. I think, those are necessary businesses. They're monopolies where they operate, but because they're so controlled by regulation, understandably and justifiably so, they have a cap on what they can do. But it doesn't mean they can't be great investments, and they can earn great returns, including their dividends and buybacks. And so it's an area that I've always wanted to try to invest. I've just struggled to find a company that would be a good fit for what I'm trying to do. Do they rise to the level of a Microsoft or an Apple or a Costco? No, but it doesn't mean they couldn't have a place in my portfolio or somebody's portfolio.
Yeah. The return on invested capital on those
Is limited.
cautious. Yeah.
Yeah.
It's an expensive business.
Yes, very expensive. Capital intensive would not even begin to cover it.
Yeah. I would also throw in like the real estate investment trusts. I mean, a lot of them have some great real estate, but to differentiate one plot of commercial land versus another, it's a tough business to differentiate yourself in. Not to say that it can't happen, and not to say they're not good investments or good businesses, but yeah, without that enduring moat and the nature of the constant competition, makes it hard to consistently outperform and be like, oh, that's a number one, right?
Right.
So that's one that I would also throw out there.
Yeah. So here are two companies that have been around for a long time. You could say they're strong businesses, but I'm not sure what people would think about their returns if they invested in them. And that would be Johnson & Johnson and Coca-Cola. Like, do you think they fall into the good, or would they fall into the great?
I think they used to be great.
Yeah.
The tough thing I have about those two in particular is historical revenue growth hasn't been impressive. So not to say that, in the future they don't improve that, but just in the last 5 years or so, it hasn't been the greatest revenue story. And so that makes it hard. Even if you're a great business, if you don't have the revenue growth, it's really hard to get that kind of market beating growth that you would want.
Yes.
What are your thoughts on them?
Yeah, I feel the same. They're companies that remain on my watch list, and I'm interested in them because of the strength of their business and what they do. But like you said, they just don't seem to grow that fast. And so it's like, okay, do I buy a treasury bond or do I buy Coca-Cola? What's going to get me a better return over 10 years? And when I have to ask that question, then that tells me that I probably don't really understand the business well enough or see where better growth could come from. And that holds me back from investing in something like that.
And I wonder if a stock like that, for as long as Berkshire holds it, if a stock like that will never get cheap where you start to become interested.
Right.
And I wonder if there's a lot of smaller businesses like that,
Mhm.
like these formerly great businesses where the shareholders have all decided, I'm just never going to sell this because I'm up like 10 to 1 or I'm up 100 to 1. So why would I sell this?
Right.
And then when they own such a big chunk of stock, it becomes hard to ever have space for you to come in, especially if they're buying back shares.
Right. Yeah, that's a great point. And that leads me to kind of a tangent, but when Buffett is no longer with us, how is that going to work with his portfolio? Are they going to unwind that position in Coca-Cola, or does that continue ad infinitum, forever? Like how or American Express for that matter? How is that going to work? If they do that, does that unlock more potential to invest in a company like Coca-Cola because you don't have Buffett holding 12% of it or whatever it is that he owns of the company?
Yeah, totally.
Well, and to that point, Berkshire Hathaway, when he passes away, I think part of his will is to sell his shares and put that in, give that to charities, as well as I think his kids are supposed to invest it in, index funds or something like that. I don't remember all the finer details, but like, how is that going to impact the share price of Berkshire if more of the shares are on the market all of a sudden?
Right. Yeah, I guess we'll just have to see how it plays out. It's definitely, I don't know if there's been much precedent for, I mean, obviously we've had conglomerates and stuff throughout the stock market's history, but to have a company like Berkshire where they own such big blocks of stock on some of these bigger names. Apple's kind of a different, Apple's like trillions. So
Right.
like, I understand he owns a lot of Apple, but at the same time, like
That's really big.
that's a really big company. But yeah, like
really big.
a company like Coca-Cola or American Express, not really that big in market cap terms. So yeah, it will be interesting to see. I don't know one way or the other, but I'll be watching.
Yeah, me too. Me
Yeah.
too. So we talked about good and great. So what are your thoughts on gruesome?
Well, as defined by the buff dog himself, the worst kind of business grows quickly, demands significant capital for growth, and then earns little to no in profit. Any companies stand out to you when we use that description?
Well, the first one that kind of screams at me is a company in the solar space, and that's Sunrun. That company has grown at 45% over the last 10 years, but it is still losing money hand over fist, not just a little bit, but like gobs and gobs of money. It is profitable on a gross margin aspect, but if you look at operating income, EBITDA, and net income, like big time negative numbers. Free cash flow is negative 150%. It's like, I don't know how you do that. So you grow these great revenues, but then you're losing everything. And so the only way it can stay afloat is, significant capital to stay in the game. And if they're not generating internally, they're probably, I haven't looked, but I'm guessing they're probably selling a ton of equity to try to generate, money so they can stay alive.
Yeah. I mean, kind of crazy when you look at the cash flow statement and the cash from operations is negative.
Yeah.
Even after adding back stock-based compensation.
Right.
Still. So
Negative.
You talk about cash burn.
Yeah. Terrible. Terrible. I mean, over the last 5 years, according to FinChat, it's had a negative 5.35% CAGR. I'm surprised it's that good. I wouldn't touch this thing with a 10-foot pole. I mean, I'm all for the solar energy as a cheaper way to, offer energy, but this thing's trading at $10 a share and it's probably $9.50 too much.
Maybe that's generous.
Yeah, maybe, maybe. To me, this falls into the gruesome camp quite easily.
Yeah. Another one I would throw Beyond Meat in there.
Oh yeah.
Just has not been profitable.
Mm-mm.
They had some early growth around the IPO, but yeah, it just hasn't been profitable. So like whether we're talking about Sunrun or Beyond Meat, what about these filters do you think could have saved an investor from losing money in a stock like this?
Yeah, that's a good question. I think probably the first one would be understanding the business, like how do they make money? And part of determining how a company makes money is determining if that's actually a way you can make money. So it's not just that you can sell something, it's that you can actually make cash from what you sell. That in and of itself would be a good filter that would probably help you filter out something like a Sunrun or even Beyond Meat. Number two would be trying to figure out some sort of valuation for the business, whether it's using something like a DCF or reverse DCF, even metrics like the PE ratio or price to free cash flow. If those are all coming up negative, and it's one thing if it's like IPO or a couple years after the IPO, but if they're not moving towards profitability after being public company for 5-10 years, then you got to start asking questions. What's really going on here? And what's the end game? What was the plan? How are we going to get there? And if you're just selling equity just to stay alive in the business, then maybe you don't really have a viable business. And that's, to me, like, I guess filter number one would probably be the place that would help hopefully avoid investing in something like this.
Yeah. I feel like you're all over it on this one. Like it is. That's it. That's the bottom line. Like, can you be profitable? Are you profitable? And it's just another reason to be very cautious if you're going into new industries where the profitability model hasn't been proven yet, and we don't know who the profitable players will be.
Right.
Not saying it can't be done, but it is difficult.
Yes. When we were talking to Jeff and Jason, they mentioned Plug Power as a company that could definitely fall into the gruesome camp. And that would have been more along the lines of the CEO maybe not being on the up and up, because I think it was Jason was telling us he's a really, really good storyteller. And so he's great at selling the vision of what they're trying to do. But because it's not really a profitable business model, really what he's doing is he's just turning around and selling revenues as a way of generating stock-based compensation for himself, and the bag holders are the ones paying him. And so that would definitely, I think, fall into the gruesome business. And that's, I guess, a different way of approaching how you would hopefully avoid that.
Yeah, I would throw Enron in the gruesome business pile, but right. In hindsight.
Yeah. That's probably the poster child for gruesome business.
Yeah. I wonder if like that would be, if we had required reading before you buy your first stock, or like watch this 5-minute documentary about Enron.
Right.
Like before you hit buy. That's the qualification. Then you're then approved to buy and sell stock.
Right.
We can make a whole list.
Yeah, before you can buy or sell your first company, you have to watch this documentary. The brokerage, whichever one you use, requires you to watch this half an hour, documentary. This is what to avoid.
Yeah, we'll throw Plug Power in there. We'll throw Enron.
Yeah, Sunrun.
Throw them in there. We could throw in your favorite Peloton.
Yeah, right.
Let's go. Let's make it. Filmmakers, reach out.
Yeah, we could be consultants. I think it's a great idea.
Cool. Okay, we hope you enjoyed the show. Thank you for listening and supporting us. We appreciate all of your questions and feedback. Take action today. Connect, learn, and grow with Value Spotlight. Peace.